Welcome, everybody, to the Daniel Krug and Associates halftime report for July 25th, 2025. My name is Rocky Istvan. Daniel Krug will be joining me in today's presentation where we're going over the economy, the markets, a little bit on tariffs and the one big beautiful bill, then recapping some of the headwinds and tailwinds we see coming in the second half of this year and wrapping up. So let's talk a little bit about the economy, where we're at year to date. What has changed in the last 6 months? I know for many this has seemed like a really volatile year, and it has been. So let's first take a look at our 25 leading economic indicators. This is the picture of the leading economic indicators back in January of this year. As you can see, a lot of the dials are green. Green means that it's positive. Yellow means it's neutral. And red means it's negative. So the things that were trending very positive at the beginning of the year, if you look at the left side, were things like monetary policy, the labor market, the business outlook, inflation, consumer spending, consumer sentiment. Things were looking pretty good at the beginning of the year. Not too much in the red. Generally, geopolitical risk is always red. It's been red ever since Russia invaded Ukraine, and it continues to stay red. But overall, the financial and economic markets didn't look too bad off from a forecasting standpoint. Now let's look at July, where we're at today. Basically, you can see a lot of the green disappeared. And what's behind this is primarily a lot of the uncertainty that has entered into the economy and the markets, the biggest driver being the tariff announcements in April. And we saw the markets react to that and staged a comeback since then. But as you can see, most of the dials that were green are now yellow. Again, yellow does not mean necessarily bad. It's just saying that there's not a positive or negative trend going. And so it's kind of a wait and see mode for the economy as far as forecasting moving forward. One of the things I want to point out is that's been of a concern is what is the Fed going to do with monetary policy? And as you can see in this chart, the black line starting on the left that's rising up we actually had zero interest rates back a few years ago. Inflation kicked in. The Fed started raising interest rates to counter that. And you can see it kind of leveled off in that 5.25%, 5.5% range. And since then, it's come down a little bit. The Feds did lower at the end of 2024 the overnight rates, but they leveled off again back in that 4.5% range. And that's about where we're sitting now. So the concern is, with the economy slowing, with all the yellow dials we just looked at, not a lot of positive trends right now in the economy. What should the Fed be doing? And this red line represents the direction that the markets are believing the Fed is going to do. They're looking for some rate cuts before the end of this year, much more next year as the economy continues to slow and bottom out, and then possibly move forward from there. One other thing I want to point out on this chart is the dotted blue line, and that's a representation of where the Fed tries to ideally be at, somewhere in between being very restrictive relative to policy, having high interest rates that tend to slow the economy, versus very accommodative policy rates below that 3% line, where they're trying to stimulate the economy. So right now, from an economic position, the Fed is being restrictive as far as the way they're managing the federal funds rates, and we're expecting some easing there moving forward. A recap of some of our major headlines of different economic things that we track. If you look at the top line here, real annual GDP growth, you can see that the U.S. grew at a rate of about 2.5% in 2024. Our consensus, if you go all the way across to the right, is that we're expecting 2025 to come in at about 1.4%. So City National Rockdale's, their kind of gauge is between 1 and 1.75%, which is the middle column there. But what we're saying is that growth is slowing, and we're expecting it to come in slower this year than last year. However, when there was talk of a potential recession back in 2024 coming into 2025, that pretty much has gone away. For you to have negative growth, the GDP number would be at 0 or below. So we are still expecting growth moving forward. Let's look at the next line, corporate profit growth. Last year, the S&P 500 average corporate profit growth was about 9.6%. Very good growth over 2023. We're expecting that to be down a little bit this year. The consensus is at about 7.5%. So that isn't as much growth in profits this year as last. However, that's still healthy profit growth. I mean, this isn't just profits, it's growth over profits over 2024. When we go down to the next line, the headline CPI year end, that's the consumer price index or the measure of inflation. That came in at about 2.9% in 2024. Still not at what the Fed would like to see at 2.5%, but it is down considerably from a year ago. And also, we're expecting that to pretty much flatten out, stay where it's at, or maybe due to this tariffs, maybe be right around 3%. So not really going down, possibly ticking up a little bit. But overall, I think it's in line if we look at historic inflation rates. Then the bottom two, the federal funds rate, which is between 4.25% and 4.5% at the end of last year. We expect that to drop somewhere in the range of around 4%. We expect 2 cuts by the Fed before the end of the year, quarter-point cuts. And finally, when you look at the Treasury notes, the 10-year end of the year with a yield of about 4.75, we still see that coming down a little bit more and being around 4.25, which in the long-term historical rate for a 10-year is about normal to be 3.5%, 4.5% range moving forward.
Well, it's been a wild ride, really, from the markets and from the economy.
Yep.
You know, you think about those dials. I would say at this point, most of the reason the dials are where they are is just the uncertainty around the tariffs. Because at the end of the day, even though many people think that the tariffs aren't going to be that big of a deal, the fact is they have not been solidified yet. So therefore, it leaves that open window. And that's why City National Rockdale is running such a big spread on their numbers right now. So they're just being cautious on it. We'll see how things play out as it moves forward.
Yeah, sounds good. Let's talk a little bit about the markets.
All right. Oh, the markets. The markets are fun. So looking at the markets, realistically, when you think about the roller coaster ride we've been on over the last 6 months, right now we're in a pretty good shape. I've always said if we're going to have a downturn in the market, let it be in the beginning so we end up with a good year. And that looks like what we're going to be feeling this year. So the beginning of the year was up and then it came down. Right now, the S&P 500 as of the end of June is looking at a 6.2% increase for the year. International and emerging markets have really kind of pushed forward. They're in the high double digits, so everything's working well there from a return standpoint. And it seems a little bit surprising with everything going on with the tariffs because you would think that the international markets might be having a harder time, but they're adapting quite well. Going down to bonds and alternatives, just really looking at the U.S. aggregate bonds and then gold. Certainly a big difference between the two right now. Both of them are considered relatively safe havens in the time of uncertainty, but you can see gold is up about 20% more than bonds. But looking at the fact that we're in a secular bear market for bonds, year to date at 4%, that's actually a very good number. And then if you look at the global markets again, now we're looking at global equities and global bonds mixed together on a 60-40 portfolio. Realistically, they're having a pretty good time because of the fact that the international and emerging markets are doing so well. And they came in midway through the year at about 9.2. Now, if you look at the S&P 500 and you kind of break down the sector's returns, we've got a pretty wide spread between the top flyers, which is really industrials and then utilities, technology, they're all running very, very high mid-year. Where we do see a bit of a drag is in healthcare and consumer discretionary, which is actually coming in rather negative. On the other side of the chart, the blue side, which is just over the last week, we're actually looking at experiencing some sector rotation going on. And you can kind of tell here your energy, which was year to date sitting lower to the bottom, has actually jumped to the top as far as returns for last week. And then if you look at financials went from the middle of the pack down to a negative on the bottom of the pack. Again, I think we're seeing a little bit of rotation in the markets. You're probably seeing some rotation in the portfolios right now as the institutional money managers start taking advantage of some of the good buys out there right now. Now, if you think about volatility and you're looking at U.S. stocks versus bonds year to date, this chart kind of tells the story of volatility, risk versus return. The S&P obviously hit a high in the beginning of the year. And then we took this, what we would call a healthy correction, which was primarily news related, and that was driven primarily by the tariffs. The market dropped below 16%, but it has certainly rebounded back, and we're actually hitting new highs again. But you can see it was a very big roller coaster ride in that 6-month process. When you look at bonds, which bonds tend to be more conservative, a little safer, they stayed pretty much in a 2% channel throughout that whole time. Took a little bit of a dip the same time the S&P and the markets had dropped, but didn't drop down too far at all. But you can also, when you talk about risk and returns, the bond market is only giving about 40% of the S&P's returns at this point year to date. Now let's mix in a little bit about the European markets. The European markets on this chart, you can see the S&P 500 over the last 5 years has really pulled out almost 100% returns. You look at where the European Union is and you're wondering why there's so much investments going on in the US. Well, look at the returns for the European Union. There's not even half of what the S&P 500 is. And then also you go down to bonds, knowing that we're in a secular bear market for bonds, the bonds are literally running a negative over 16% over the last 5 years. And it certainly is putting a drag on portfolios. And the more conservative you are, the bigger the drag is. And this is kind of represented on this chart. Again, this is another 5-year chart. At the top of the chart on the right-hand side, you've got the S&P 500, again, up over 95%. And at the very bottom of the same side of the chart, you've got 100% bonds, which is showing a negative 17%. You think about doing stock mixes to reduce the risk in the portfolio and stay diversified. Well, the more you put bonds in it, as you can see, the lower the returns were overall in the portfolios. Anybody who was at a 30% equities, 70% bonds over that whole time period, the 5 years, basically ended up with about a 5% rate of return. And then again, you go to the typical 60-40, and we are talking about just US markets. And the typical 60-40 is sitting at about 30%. So very different than a full equity market or portfolio if you were just in nothing but the S&P 500, which is really sitting at over 95%. So a big, big drag on the market when you're working with bonds. That's why it is so important to have some alternatives in your portfolio that are not correlated to the market or to the bonds. Or if nothing else, it's only correlated to the upside in the market. So what would that alternative be? Well, it could very well be high yield money market accounts, which we've been in those for our clients, which are paying out really anywhere between 4 or 4.5%. or it could be overfunded life insurance, which many of our clients have overfunded life insurance. It's paying out a good return on it. And guess what? It's tax-free. So it's a double blessing for you. And it certainly helps these mixes, whether you're an 80-20, 60-40, or 30-70, it really increases the overall returns because you don't have that major drag that bonds are giving. Now, moving forward, let's break down the bonds into different areas here. When you're looking at the left side of the chart, you're seeing the best returns really was on a global aggregate or global high yield index, which is representing bonds that are global bonds. And because of the additional risk premium that are given, you're seeing some real good performance in them. But you're also taking a much greater risk. You go all the way to the right side of the chart, where are we having real problems in the bond market? Well, it's muni bonds. The reality is with the high interest rates, it's putting great pressure on the muni bonds. And people are saying, why do I want to be in a bond that's not giving me the returns that even a treasury is giving me? So there is a lot of pressure on the muni market right now. Now let's go forward and let's take a look at the bond market from a bigger picture. Now this chart shows you a chart from 1980 to 2024. And on this chart, I'm going to point a couple things out. So this is the Bloomberg U.S. Aggregate Bond Fund, or bond index. And on the top, you've got a secular bull market, and you've also got a secular bear market highlighted in the green and the red. The secular bull market, when you think about it, the secular bull markets in a bond secular market tend to last over 30 years. And when you look at this bull market, you can really tell that the bonds were performing very, very well. Now, conversely, let's go to where we are today in a secular bear market. We are 11 years into this bear market right now. And if you just look at the returns, what we did on this chart is we put a red dotted line at the highest return, which is 9%. For the bonds. And when you look over into the secular bull market, you can see, gosh, it almost looks like about half the time the bonds were over 9%. And keep in mind with this chart, what it shows you is with the blue bars, that tells you where the market ended up that year. The red dots kind of tell you where intra-year, where the bonds actually were at. So each year you see that the bonds go negative almost all the time. But the problem is in the secular bear market, we're just not seeing it come back like it does in a secular bull market. And that's why the bonds just are not performing like they used to. So we could be in the secular bear market for many years to come. We're just going to have to wait and see. But this is why you really need to be with a firm that is a tactical manager and has some alternatives to the bond market to allow you to still get returns when others in the market are struggling. This chart here is the same type representation, but what we're looking at is the equity market, the S&P 500. And what you probably already noticed is that these secular markets tend to be a lot shorter when it comes to equities. And they tend to run between 12 and 18 years. Right now, we're sitting in a secular bull market, and we've been here for, about 11 years. So in this secular bull market, we are still looking at some more running room. And if I was a betting man, I would say we probably still have another 4 to 5 years of this secular bull market as we're moving forward. So again, you really want to make hay while the sun's shining, and the sun is shining in the equities market today. Well, that was a lot, wasn't it?
Oh my gosh. Yeah. Well, that was good. It kind of represented not only what's going on today, but keeps it in historical perspective.
Yeah, that's important.
So good stuff.
Yeah, it is. And really, I mean, you've brought out in other webinars and whatnot what the equity markets have done, and showing the chart of how the markets are typically down almost every single year.
Right.
It's really where you end up is where it's important. And the fact is, with the equity market, you're really going to be up, what is it, 4 times for every 1 year that you're down? And those are pretty darn good odds, and it's a good reason to just stay invested in the market.
Right. So one of the things we want to talk about is a couple minutes on tariffs, so we can move forward on that. Wanted to start with this chart. It ties back to the market and what's gone on since April, when we had the downturn in the markets and there was a lot of instability and volatility. What's interesting here is this is tracking the buybacks by large companies, the S&P 500 companies, when they buy back their stock and how much they're investing in buying back their stock. And looking at this chart, this goes back to 2015, so the last 10 years or so. If you notice these bars, it's representing how much stock buybacks were taking place in the first 5 to 6 months of a year. And in 2025, we actually saw absolutely historical amount of stock buybacks this year. And frankly, one of the reasons is because the market made such a dip in April. Companies started looking at this and said, hey, we can buy our stock cheap, wait for it to go back up, and start unloading some of that and putting that new capital to work. So that is what's going on. If you look at even 2022, which is 3 years back, that's the next highest amount of stock buybacks. Why do you suppose companies were buying their stock in 2022? Again, it's because the market was actually down. If you remember Dan's chart just a couple minutes ago, 2022 was actually a down year. Corporations know their products. They know their ability to produce. They know when their stock is on sale. So if they know to do this, what do they know that we don't know? They know that the market's going to come back. They see the opportunity of buying their stock while it's down and reselling it again later at a higher price. So I just wanted to point that out. Tariffs actually created an opportunity, and those of us that recognize down markets as opportunities take advantage of it. Let's talk a little bit about tariff effect on inflation. So far, if you look at the chart on the left, this chart is through the end of June. We are not seeing any uptick in inflation at this point. Now, there are things that can counter inflation, and we're going to talk about that a little later. But the reality is inflation is not increasing at this point as a result of tariffs. We're not done with the tariffs. We don't know where this is all going to end up. But so far, it's been a non-factor, even though if you listen to the news, you would think it would be. On the right side, what we did is just show you the breakdown of how different sectors of the economy weigh in on inflation. And as you can see, shelter is the largest, okay? And shelter is not really being impacted by tariffs. So if you think tariffs are going to be a big weight in overall growth of the economy or inflation, probably not, because the biggest sectors are not going to get impacted by it. Here we want to talk about the effective tariff rate and what is that manageable, or is that going to blow our economy and markets out of the water? On the left side, we put a very long historical chart in here going all the way back to the 1800s. Because actually, if you think about it, tariffs have not been a conversation much in the past 20, 25 years. But at one time it was, as we were building our country. And you can see all the way back to 1828. We had huge tariffs on imports into the United States. They started coming down. They kicked back up again in 1861. A little bit down again, and then kicked back up in 1890. Not a whole lot going on until 1930, right before the Depression. We started raising tariffs on imports from other countries. Since then, it's gone down, and it's almost been negligible. The big note here is the reason it's been so low is primarily because of the NAFTA agreement. We made huge concessions with Mexico and Canada as far as trading on the North American continent. And that's why tariffs have been, I think, artificially low during this time period. And actually, Dan, the United States suffered a little bit from this with the impacts to the loss of jobs, manufacturing, and things like that in the United States. A lot of that started getting outsourced. We don't want to have high tariffs. We want fair trading, and I'm hoping that that's what the administration is going after. You see the dots on the right side of that left side chart, the brown dots. We were initially at a high of about 30%. That's already dropped down to half, and we believe that's going to settle in, actually be a little bit lower. When we look at the right side of the chart, this is just to give you a comparison of country exports as a percent of GDP. And why is that important? Well, if you look at the United States, our exports only represents about 11.8% of our total GDP. So what this means is that primarily the growth of the economy in the United States is contained within the United States. It's our own buying and selling to each other. Counter that with what's going on in Germany. Germany has to sell a lot overseas to be able to just sustain their internal growth rate. So they're very dependent on other countries. In my opinion, that's not necessarily a good place to be at, especially when there's times of volatility and trade wars that can go on. Almost half of their GDP is dependent on other countries buying their products. You can also see in here, the final point to this chart is Canada and Mexico. Significant portions of their economy and their growth is dependent on exports. And that is what the current administration feels is out of line here. And so what's the impact for tariffs on the United States? Not as bad as other countries around the world.
Yeah, I think you're right. But looking at this chart, I was just thinking about something, Rocky. I wonder what would happen if you overlaid income tax on this tariffs. So as tariffs were going down, what do you think was going on with our income tax? It was going up because at one point we had what, 2% tax?
Right.
And in the beginning, the young country was screaming over that. And since then, the tariffs have gone down, which means other countries paying us has gone down. And our income tax has gone up, which means what? There's more money out of our pocket paying for things than other countries paying for it.
Right.
So that's an interesting, I would love to get a chart and overlay them because I think most people would be like, you know what, maybe tariffs aren't so bad.
Yeah. Well, fair trade is what I think is ultimately what we're going after.
Oh, I don't know. I'd like to have lower taxes, Rod.
Yep. Let's move on.
All right. Well, speaking of taxes, we've got the one big beautiful bill. And ultimately, there's been a lot of talk about this, some of it good, some of it bad. I'm kind of thinking that if you look at both sides, both parties, and you took the information that they're giving us and kind of mixed it together, it's probably more of the truth of what's going on with this bill. There are some real good things in it. There are some things that some people don't like, for sure. But what we're going to focus on really is more the tax portion of it, things that are really hitting home to our clients. So first of all, I think we all know that on July 4th, President Trump signed the One Big Beautiful Bill Act. And this bill is basically modifying the 27 Tax Cuts and Jobs Acts. So some of that is going to stay on like it was in the past. Some is being modified. And we're going to talk a little bit about some of those modifications. The provisions will go into effect January 1st, or I should say between January 1st of 2025 and January 1st of 2026. And when you're thinking about the provisions, let's first talk about the income tax rates and brackets. Now, I'm not gonna put up any charts about where the brackets are, but I'm going to talk about where the changes are going to be coming, where it is coming, and who it's going to be helping. In this case, the income tax rates that are going to change, really the brackets, there's going to be an additional extra inflation adjustment to the lower three brackets, so 22, 12, and 10%. I'm thinking that's more middle class and lower income people, right, Rock?
Mm-hmm.
So that's where the benefit's going to come. And how is that going to benefit them? Well, as the inflation adjustment is actually going to increase the dollars within each one of these brackets, which keeps more of the money in the lower brackets, less tax for those individuals. So that's a plus up for middle class and the lower income individuals. You look at a limit on itemized deduction. This one actually isn't going to affect anybody but the top income earners. In other words, those in the 37% bracket or higher. And at that level, there's going to be a reduction of the itemized deductions that you have on your returns. So it doesn't really hit the average person. It is going to hit higher income earners. When you look at the gift tax and estate exemption, this one again, this is really going to benefit more of the wealthy. And what I mean by that, well, most of us don't have $15 million at a single individual or in a state worth $15 million. And if you're married, well, a lot of us don't have $30 million, right? So it is going to help benefit we'll just say the high net worth individuals. The state and local tax deduction is really going to be applicable only for tax years 2025 and 2029. And what it does is it temporarily increases a limit to the $40,000, which gets reduced by about 30% of the taxpayer's modified adjusted gross income on anybody who has income greater than $250,000 for a single person and $500,000 for married. So you can see here, it's high income earners that are going to get this, their state and local tax deductions reduced. And in some cases, gosh, they're not going to get a whole lot of benefit at all. Now, when you look at the limit on some of the itemized deductions, this again is going to be hitting more high-income earners. So what it's going to do is it's going to reduce the value of all itemized deductions for taxpayers in the 37% bracket or better by approximately 5.4%. So again, the bottom two in this list are really not going to help any of the high income people. It's going to hurt from a tax standpoint, but it's not going to touch the average person or low income earners. You go on to the next one, charitable deductions. Beginning in 2026, the taxpayers who do not itemize their deductions may claim a charitable deduction of $1,000 for singles and $2,000 for married. So if you're one of those that just don't have enough to itemize, but you're still giving to charities, this is actually going to help you and reduce your taxes as well. Qualified business income deduction. Now, many might say that, well, this is just going to help the rich. Well, when you think about how this one works, this is designed more for small business owners. And the way it works is that the taxpayer may deduct 20% of their qualified business income if they run a partnership, an S-corp, or a sole proprietor. If they're a sole proprietor or any of these other two, you actually have what we call pass-through income, where the money comes directly out of the company and goes on to the individual's 1040 tax returns. They are going to get a benefit. And if you think about what happened in 2020 when this came about, a lot of small business owners poured money right back into the business. And for our clients, we did the same thing. We ended up doing a full remodel at that point, and it was helped by this tax cut we had. So not only did our clients get a much better environment to come in, our staff works in a much nicer environment, but at the same time, when we were doing construction, we were working with construction people, and that's helping the economy. And this is what that qualified business income deduction was designed to do. And if you think back in 2020, it really helped spur the economy. Now let's look at the alternative minimum tax. Again, no one really likes this one, but it's not going to change that much for the average person. But if you're a high income earner, that's where the exemption that you get is going to be phased out. So again, this is a bit of a knock for high income people. Now, let's look at a couple other big ones out there. The no tax on tips. And this one's going to be indexed annually for inflation. And what it does from 2025 to 2028, it creates an above the line deduction for qualified tips. So, and it goes all the way up to $25,000 for an individual. This is a big deal. Now, it's not going to help really high income earners again. So it's not designed for them. It's designed for the average person and low income earners. Because really, once you get above 150,000, it starts phasing out for single taxpayers. Over 300,000 for married couples also is phasing out. So they're not going to get quite the benefit. And by the way, there's not a whole lot of people making tips that are in the $300,000 range. So what was it targeted for? It was targeted to help the low income bring more money back to themselves. Here's another one. This kind of works the same way. The no tax on overtime, again, indexed annually for inflation. This one starts 2025, works on till 2028, and it works very similarly to the no tax on tips. So this is all designed to try to put more money in the average person's pocket and allow them to hopefully get more money back into the economy and boost the economy. Now, many people might be asking, what about President Trump's pledge to eliminate tax on Social Security income? Well, I'm sure everybody knows by now that it didn't quite happen the way he wanted it to. Now, the question is why? Well, it really went to the fact that he knew that he did not have enough votes in the Senate and the House to be able to get a two-thirds vote to revamp the full tax bill. So what did they have to do? They had to go through a budget reconciliation, which has rules, and those rules prohibit significant changes to Social Security programs. So that's why it didn't go through the way President Trump wanted it to, but there was some reconciliation done. And when you look at it, it's actually still going to be a benefit for those who are taking Social Security over age 65. And what it does is it brings in a new additional standard deduction bonus of $6,000 for anybody 65 years and older. Now, there is some qualifications on this. So let's go through a few things. First of all, relative to the provision, there is a phase out to this. So if you're a single person making over 75 or a couple over 150, it does start phasing out at those levels. So the no tax on Social Security income really is more of an enhanced deduction. Again, it's going to run from 2025 all the way through to 2028. And it is going to be a supplemental deduction on top of deductions we already have. So let's kind of go into that. First of all, for 2025, single filers 65 years or older, they currently have a $2,000 deduction that they can take. And if you're a married couple, both over 65, it's going to be about $3,200, $1,600 apiece. Now, for example, the current standard deduction is $31,500, but these people get to add up to an extra $3,200 onto it, bringing them up to $34,700. Well, now let's look at it adding on this bonus. The way that works is when you're looking at a married couple, they still have that $31,500 deduction plus the $3,200. Plus, if they're both over 65, an additional $12,000. So now we're actually sheltering $46,700 in income. So that is going to bring down the income tax on a lot of people's 1040 returns. And if you've done any kind of tax mitigation with us, you're going to be able to see, in many cases, zero with your tax returns through that tax mitigation. So that was a lot, but boy, there's a lot out there. And think about it. This is just the tax part of it.
Right.
But the tax part of it is what most of our clients are concerned with, because that's what's going to impact them. So we're going to hear more about this in our January workshop when Brenda Hunter from Hunter CPA Group comes into the Java workshop and talks specifically about this. At that point, we're going to have this pretty much shored up. The CPAs will have a good handle on how these taxes are going to work moving forward.
Sounds good.
Yeah. So why don't you take over on economic headwinds and tailwinds? See where we're going.
Let's talk about headwinds first. Headwinds are things that we see are hindering progress in the economy or potentially hindering progress in the economy and our markets. First is because inflation is still above the Fed's desired rate of 2.5%, they've been really hesitant to lower rates. They want to see slower growth. They want to see things slow down in the economy, which is happening. And one of the areas that is probably the most stubborn is things like wages and service inflation, which are declining slower than what was originally expected.
Yeah, you know what, Rocky? I don't think that's coming down either. I mean, it may level off and inflation will catch up to it, but that part of the inflation, it's not really coming down.
Yep. So another area, consumer spending has slowed. Again, we're a consumer-oriented society. 67% of the growth of our economy comes through consumer spending. So the fact that that's slowing, that could be potential issues for the economy moving forward. However, another thing that is in headwind is that consumer debt has risen. Now, this has actually started back in 2024 and maybe even a little bit earlier that we've started to see a slight rise in consumer debt. Again, one of the reasons behind this could be things like the fact that mortgage rates, auto loan rates are higher today than they were just a few years ago. So the cost of servicing debt is higher. It also keeps the debt at a higher pace moving forward. However, I do want to point out that where it's at right now is pretty much close to historical levels. So we don't see anything that would be alarming at this point right now. Although we're going to monitor, consumer debt moving forward. We don't want to see it getting out of balance where people are struggling to pay their mortgages and car loans and things like that. Tariff uncertainty weighs big on the potential for GDP growth and inflation. At the end of the day, if it costs more to buy the materials you need to produce products and or things you need in your home or in your business, that cost is going to have to be absorbed or passed on. So that could take a hit to the economy. However, we're starting to see some of the signs that we're getting agreements that the tariffs aren't going to be as high as originally thought. So there's some positives on the tariff side there. And ultimately, we've got to deal with geopolitical risk. This is something that also will probably not be going away. I don't expect major wars to end or political unrest to end immediately. We've seen a little bit light at the end of the tunnel, maybe in Israel and Iran, but again, it's very fragile. But that's something that's been out there, and the markets tend over time to shrug that off. Let's talk a little bit about things that are moving in the right direction that we see as a positive going into the second half of this year. The probability of a recession is very, very low, almost gone. I know a year ago, we were talking in some of our webinars and workshops on the probability of a recession in 2025 being somewhere around 40-50%. People just didn't know. Well, that's gone way, way down. We don't see that coming, and that's why it's not being talked about a whole lot in the news. We still expect the Fed to lower rates this year, 1 to 2 times. Hopefully, we see 0.25 point rates cuts this year, and it continues into next year. Rates right now are still what we would call restrictive. It's hindering the economic growth of the United States, but we believe the Fed's going to start getting on board and moving forward. Labor market, talked about this too. It remains resilient. And what's really interesting about this is that even though when we talked about the economic indicators, we saw that it looks like the economy's slowing, a lot of the green dials moved to yellow, meaning that it's in between. We're not sure if we're heading towards growth or slowing, but wages have been able to keep up with inflation. So that means those people that are working, even though it might cost a little bit more to buy groceries this year than last year, their wages are going up with it to compensate and cover for that. A big thing too is that we're starting to see the signs of a revitalization in manufacturing and infrastructure capital spending. Now, will we realize the benefits of this year? No. But as you build plants, as you plan to produce more product here in the United States, that's going to only help the long-term economic growth and job market in the United States. Another thing that has changed in the last 6 months, there's been a real change in regulatory environment as far as what the government's mandating, imposing on companies in the process of producing their products and services. So especially the oil industry has seen some regulatory positives moving forward, allowing them to produce their oil in the United States. So we see this as a real positive and not something that's just a one-time trend for this year, but continuing on through the next couple of years. So we see a good pro-business environment and increased manufacturing and infrastructure spending over the next 2 to 3 years moving forward. The fact that it's happening with big companies and big industries is going to also spur other smaller, let's say, companies to look at increasing their investment, feeling more confident about the economy as they see these things taking place. So that's kind of in a nutshell where we think we're moving. We think it's fairly positive. So any final thoughts on this before we wrap up?
Well, I think we're going to have a very good next 6 months. I think from a market standpoint, we're going to be in double digits. Our clients are already looking very good midway through the year. I'm seeing a lot of good things for the U.S.
Me too.
All right, here's what we've got. Our actions items for 2025. First of all, we're going to keep you informed through regular communications like this. We're going to manage your investments according to your personal investment strategy, and we're going to stay on top of any kind of changes in the market environment and make prudent adjustments where necessary. Now, for 2025, what's your actions items that you are responsible for? Well, first, keep us in the loop with any kind of important changes that you have. And tell us about any concerns you have about your investments. Let's talk through them. Maybe you want to increase your risk. Maybe you want to lower it. You need to communicate that with us through our meetings. And then make sure that your important legal and financial documents are up to date. This is extremely important, and we do an annualized questionnaire for our clients to make sure you stay on track. So if we get into an area where you need these documents updated, we're going to bring that to light. We're going to work with you to get it done. If you see something today that you need to have corrected, please talk to your advisor about it. Upcoming events. Okay, we do have a webinar coming on August 22nd. So look for that coming down the road here. We've got a Java workshop, and this workshop is going to start October 17th, which is a Thursday. We're going to have a second one run on the 18th, which is a Friday, just like we normally do for the Java workshops. This is a data security threat workshop, and we're going to have a special guest speaker, Al Vidovic. He's the founder of Apple Wisdom. He's going to come in and talk about what is out there in the environment trying to take your money. So please come to this. This is a real big one, especially if you're a business owner. This is important stuff for you to understand, and Al's going to give you tips on how to stay safe. And if you look at some of these workshops or some of the webinars that we've had, and you're like, well, what did he say during that? What was Rocky talking about? You can go to our YouTube site or just go directly to our website at mydkna.com, click on Watch Us, then DK&A YouTube, and it'll bring up our YouTube channel where you can look at all the snackables, which tend to be 3 to 5 minutes, or the full run of whatever video we did. And that stays up there for pretty much for, what is it?
Perpetuity.
Perpetuity. There it is, perpetuity. So take advantage of that because it's out there. And like we always say, you take care of your family. There's no need to worry. We're going to take care of you. We're ready for 2025 and beyond. Goodbye.
Have a great day, everybody.